Hey there, accounting students. Today I'm diving into IAS 23 borrowing costs. Sounds a bit dry? Trust me, it's crucial and not as complicated as it seems. Let's break it down together. First, what are borrowing costs? Simply put, these are interest and other costs that an entity incurs in connection with borrowing funds. Think of it as the price you pay for using someone else's money. Now, IAS 23 tells us how to handle these costs in our financial statements. The key point here is that borrowing costs directly attributable to the acquisition, construction, or production of a qualifying asset must be capitalized. This means you add those costs to the cost of the asset. But what's a qualifying asset? It's an asset that takes a substantial period to get ready for its intended use or sale, like buildings, plants, or large machinery. Okay, let's get into the accounting process. Step 1. Identify which borrowing costs are directly attributable. This includes interest on the loan and other costs like fees and commissions. Step 2. Calculate the amount to be capitalized. You start capitalizing borrowing costs when you incur expenditures for the asset, incur borrowing costs, and undertake activities necessary to prepare the asset for its intended use or sale. Capitalization continues until the asset is substantially ready for its intended use or sale. Here's an example. Imagine you took a loan of $500,000 to build a new office. You incur interest of $20,000 in the first year. As construction progresses, you capitalize this interest by adding it to the cost of the office building. So, if you spent $400,000 on construction this year, the office building's value on the balance sheet would be $420,000. Next, let's talk about journal entries. When you capitalize borrowing costs, the entry looks something like this. Debit the qualifying asset account and credit the borrowing costs account. For our example, the entry would be debit office building, $20,000, and credit borrowing costs $20,000. Remember, if borrowing costs are not directly attributable, they should be recognized as an expense in the period in which they are incurred. To wrap up, here are the key takeaways. 1. Only capitalize borrowing costs directly attributable to qualifying assets. 2. Keep capitalizing until the asset is ready for use or sale. And 3. When in doubt, refer to IAS 23 for guidance. Understanding IAS 23, borrowing costs is essential for accurate financial reporting. So, take the time to grasp these fundamentals. You'll thank yourself later when you're preparing those financial statements. Alright, that's it for today. Keep crunching those numbers and see you in the next session.